Hi, this is Nadia Al-Khatib with the July 2019 monthly market analysis. Let's jump right into the news. So let's start with the FHFA actual year-over-year price change in regards to individual markets. So what we can see in this map are individual regions. What we can see is that in each region, we had a very nice uptick in prices. So if we go all the way across the board, we're still seeing really strong appreciation. We're not seeing that 7, 8, 9% that we saw on the West Coast, but we're still seeing strong appreciation. Remember, normal historic appreciation is 3.6%. And every one of the regions did better than that in the last year. Now, when we break it down by state, the FHFA report, we can also see that there's no state in red, which means that there's no state losing value. Now, there's some concern that there might be some individual metropolitan areas losing some value. Unfortunately, San Jose is one of them. But across the board, we don't have a challenge whatsoever. And there's no state with a challenge. That doesn't mean that appreciation isn't slowing. The new Case-Shiller report shows exactly that. We're no longer at that 6 to 6.5% national appreciation we saw just a year ago. We're back down to normal numbers. But if it had fallen as low as 3% and now we're back up again, the historic numbers of 3.5 to 4%, and that's where we're bouncing right now. It's going to be interesting to see what happens in the months to come. Let's look at CoreLogic report because it has some great information. Here's the actual year-over-year percent change in the price per state. So you can look at the states individually and see exactly where there are challenges and where there are no challenges over the last year. But probably more important is that CoreLogic forecasted what's going to happen over the next 12 months. And as we can see, the entire country is very strong. As a matter of fact, they've upticked what they thought the national average appreciation increase would be to 5.6%. And we can see that the entire country is strong state by state, and their national number is 5.6%. As a matter of fact, they've upticked that number from last month, and we can even go further than that if we take a look at their May, June, and July reports. Each of these 3 months, they upticked where they thought the next 12 months appreciation would be. So what does that mean? Well, what they're really saying is that where they thought appreciation was going to be 90 days ago, they're starting to be more optimistic about it. And the following months, they went from 3.6 to 4.7. And then the last 30 days, they said, wait a second, it looks like houses are going to appreciate at a higher level than we originally thought. And they upticked that to 5.6%. So what we're seeing now is apparently, at least according to CoreLogic, we've hit bottom and we're making a turn back up. I don't think we're going to return to that 7, 8, and in some regions, 12% appreciation. I think we're going to bounce around between that 3.5 to maybe 5.5% home appreciation. And the reason they're seeing that turn is demand ticked up because interest rates have gone down, which we'll talk about in a second. So the home price expectation survey is a nationwide panel of over 100 economists, real estate experts, and investment and market strategists. Now, if we put all of their projections together, we can see that they think that between now and 2023, nationally, prices will be up 16.8%, and we're going to see a nice appreciation over the next 5 years. So at least average appreciation, meaning we're not going to see any depreciation. Now the bulls, the top 25 of those more than 100 people surveyed, think it's going to be much higher than that over the next 5 years. So we're going to see over 5% appreciation annually for a total of 27.7%. But probably the most important number on that graph is the bears, the most negative, the people that always see the glass half empty. Even they think that over the next 5 years, we're going to see appreciation limited at 6.7%. But again, even the bears are not considering depreciation. And when we take a look at it over the next 5 years, all projections this year, they think that it's going to level out at 4.1%. Then the pendulum is going to swing a little bit too far the other way. Remember, we've talked about the fact that we're on the longest stretch of an economic recovery. There's going to be some slowdown in the economy probably. And they think that those values will drop below that 3% until they go back up to normal appreciation in 2022, 2023. So let's also look at the projected home price percentage appreciation going forward from 6 major entities. The Home Price Expectation Survey, which we've just looked at, the Mortgage Bankers Association, Zelman and Associates, Freddie Mac, and the National Association of Realtors, and finally Fannie Mae. And each one of these institutions are projecting again that we're going to continue to see appreciation, limited appreciation, but again, there are no numbers on that are red. So the experts are saying that there shouldn't be any fear that we might be looking at depreciation. And when we take a look at the increase in home values from 2005 to 2018, it's pretty interesting. People that were able to stay in their homes pretty much across the board had a really nice appreciation, and no one has experienced a depreciation, at least not from the state level. So real estate is a great investment, and even those who bought at the height of the market back during the boom before the bust, even they were able to stay in their home. The ones that were able to stay in their home saw great appreciation, and the probability of home prices being lower in 2 years, according to Arch Mortgage Insurance's report, as you can see here, they think that North Dakota, because they're tied to energy, they think that there's a moderate probability that home prices could be lower in 2 years, but the whole rest of the country is either a low probability of it happening or even a minimal possibility that it's going to happen. So again, for anyone thinking that, if the economy slows up, then we're going to see some sort of return to devastating numbers. That's just not the case, and that's what this particular month's report is showing us. And here's a graph from the Z report. It surveys the bottom 1/3 of the income group in the country, the middle third of the income group, and the upper third. And that will represent starter homes, lower priced homes, the mid-priced homes, and the upper priced homes. And as you can see, the gray is historically low, historically how much optimism they have for future appreciation. So in the bottom third, historically 62% think that prices are going to continue to appreciate. Right now, 65% above the average. And the middle third income, the average cost years is that 70% believe the prices are going to continue to appreciate nicely. That number is up to 74%. But the interesting thing, on the upper end, the higher income group, their average is 74%. But right now, only 69% believe that there's going to be nice appreciation going forward. So I think in the upper end, and we do have a little bit of a challenge because a tremendous overabundance of inventory in some areas of the country, not necessarily here. And the consumer themselves, that's who's being surveyed here. The consumer themselves believe, that in the upper end, we're going to see some price pullback. Now, shifting gears entirely, I want to talk about what I believe is a tremendous opportunity. Here's the percentage of investor purchases. A new report put out by CoreLogic of all the homes sold in this country, 11.3% were purchased by investors. Of the starter homes, over 20%, 1 out of 5 starter homes, are purchased by an investor. The move-up homes dropped to 7.8%, and the high-end homes are at 6.3%. Now, it might look like the institutional, professional investors are getting more involved, but if you get deeper into the report, you'll see that it's not necessarily the case. As a matter of fact, Rolf McLaughlin at the National Association of Real Estate Editors, it's a conference that was done late in June, he said that investors buying activity in the US is at a record high, and our records go back confidently about 20 years. So, for the last 20 years, investor buying activity compared to the last 20 years is at a record high. So, what's going on and why? Well, it turns out that it's not the big institutional guys that are leading the increase in home buying. It's actually the individual investors that have bought between 1 and 10 properties over this 20-year period. They're the ones that are really leading the increase in investor home buying. Let's take a closer look at their report. What we can see is that what is considered the mom and pop investors, someone who bought only 1 to 10 houses over the last 20 years, well, that number is increasing dramatically. But the professional investors, people who buy houses and, that's kind of their living, that number has dropped. And the institutional investors, the people purchasing over 100 homes, such as single family rentals, that number has dropped significantly. So it's actually the mom and pop investors that have been investing heavily. They often fix up the homes and turn them over. They're flipping the homes. They often are taking a property that is not sellable to that first-time home buyer and making it sellable to the first-time home buyer. So they're not taking inventory off the market, they're actually adding more inventory to the market. Now there are more and more sellers now putting their house on the market for a slew of different reasons. And I'm not the only one that thinks that. Mark Fleming, the chief economist at First American, did a survey. Here's a quote from him. He says, title agents and real estate professionals indicate home buyers encouraged by unexpectedly lower mortgage rates in 2019, a tailwind happening to boost demand and inspire existing homeowners to sell their homes. All right, so now because interest rates are lower, we'll get to where they are in a second. It's increased seller traffic. Here's the Realtor Confidence Survey. There are more states that used to be totally gray and orange, which is either weak or very weak seller traffic. Now, the number of people talking to agents about selling their homes is that traffic. But what we're starting to see is across the country, the very weak seller traffic has disappeared. There are still some weak states, but more and more of the country is turning medium blue or darker blue, meaning more and more sellers are coming out, putting their house on the market. And I think that some of that is due to our mom and pop investors. But remember, if we take a look at interest rates, they shot up at the end of last year, right? And that slowed everything up. And they started going up in the third quarter. Now, in the fourth quarter, it really slowed things up. And since then, since December, interest rates have dropped. As a matter of fact, their lowest rate in 3 years. That does two things. Number one, it spurs buyer demand, not just from the first time home buyer, but also that second and third time buyer who currently owns a house and has put it on the market. And the second thing that it does is people who had low interest rates on their home and maybe were saying, well, I'm not gonna sell right now, I don't want to lose my low interest rate. Well, now that rate lock, as they called it, doesn't exist, because they still can buy their next house at a very low, below 4% interest rate, but that window of opportunity is going to disappear. And we have to make sure we take advantage of that because while it's here. And I think that time is right now. As usual, please reach out if you have any questions. This month I'd like to end with 4 quotes telling us one thing. The second half of this year is going to be much better than the first half, and we have to be prepared, take advantage of that, because the second half of this year is going to be extremely strong. Let's start with Danielle Hale, the Realtor.com's chief economist. She says, lower mortgage rates, higher wages, and more homes for sale have helped counteract rising home prices and ultimately made it so that buyers are able to afford more than last year. Buyers are able to afford more than last year. Affordability is actually increasing, meaning it's more affordable to purchase a home and buyers are out there buying. But probably more important, we're not just talking about first-time home buyers. There are people who currently own a home that are saying it's time for us to move up. Ralph McLaughlin, again, the deputy chief economist at CoreLogic, says with mortgage rates flat and inventory picking up, we expect more buyers to take advantage of easing housing market headwinds. Sam Cater, the chief economist at Freddie Mac, agrees. The drop in mortgage rates over the last 2 months is already being felt in the housing market. In the near term, we expect housing market to continue to improve from both a sales price perspective, a sales and a price perspective. So the number of sales and price perspective. So the chief economist of Realtor.com, the chief economist at CoreLogic, the chief economist at Freddie Mac are all saying the same thing. We're heading into a time when sales are going up in a big way. And the last quote I want to give you, and that's from Ivy Zelman and the Z Report. Key metrics tracking existing home sales demand have been on an upward trajectory so far in 2019. This portends positively for our forecast for existing home closings to increase by 1% in 2019, despite a 3% decline throughout the first 5 months of the year. That's nationwide, obviously. That's important. This year was the exact opposite of 2018. In 2018, we started super strong and then petered out at the end as interest rates went up. This year, we started out a little slower. We had no momentum going into the year, again, nationwide, but the second half of the year is going to uptick in a big way. Our outlook implied 4% growth for the remaining months of the year, predicated on more supply than last year, the decline in mortgage rates, moderating home price appreciation, and improving affordability. Now, the second half of the year is going to be very, very powerful. This is Nadia El-Khatib with the El-Khatib Group. As always, please reach out with your real estate questions or needs.